Good morning. Monday, April 21st. Zach Howard. Here's your morning market update. That's from my notebook over the weekend. First up, US dollar, DXY. Look at this move here. In the biggest currency in the world, King Dollar, previously known as Liberation Day, April 2nd, 104 to touch of a 97 here to start the week. That is a massive move in the globe's biggest fiat currency. Confidence is being lost in deploying capital in U.S. instruments, whether that's U.S. treasuries or U.S. stock market. You're seeing it reflective in that lower DXY. If you're a fund manager in Europe, in Asia, and you see your real returns be eroded like this from 104 down to 97 when you do your currency adjustment, this is a massive move. Tack on that, the declines in those Mag 7 stocks or in U.S. Treasury yields, rising yields equals lower value of those bonds, especially those longer duration bonds. This is a massive decoupling of capital leaving the U.S. This is a big deal. If you're managing 10, 20 billion, $100 billion, you're talking 7-8% real return losses on just the exchange side of these trades. These are professional money managers. They don't chase their losses and double down here. They get out and they get out immediately, and selling begets selling. And that's what we're seeing here in the US dollar. Record number of global investors are now attending to cut U.S. equity exposure. I talked about it last week. When you look at the Canadian pension plan exposure to U.S. assets over the last 25 years, the same thing is going to be true in European pension funds, Asian pension funds, etc. Capital is being taken away from the U.S. market and brought back to those home countries to be redeployed. On the margin, this is making a big difference. Where you see that through the price of gold, which continues to rise, because that's capital that previously would have been allocated towards U.S. treasuries as a long-term duration holding. Now pension funds, countries are saying, you know what? I'm going to own physical gold ETFs perhaps, instead of that 20, 30-year U.S. treasury, which leads to this term you're going to hear often now in markets, market commentary, a bear steepener in the U.S. treasury curve. What is it? It's when that U.S. 2-year yield curve or that 3-month yield curve continues to fall because the market is pricing in potential Fed central bank cuts ahead, but the longer term duration, particularly here on this chart, is the U.S. 10-year yield or the U.S. 30-year yield, now approaching again 4.9%. When that rises and that spread widens, that is known as a bear steepener. That's what's happening. There is less demand for those long duration treasury bonds, the bonds that the U.S. government finances as long-term operations. Massive week in U.S. equities in terms of reporting. Over 120 companies in the S&P report this week, I believe. Roughly $10 trillion in market cap. I can't wait to see my favorite make-believe company, the car company here, reports tomorrow. 6 months, maybe 12 months, definitely on these robo-taxis. It's a continuous spin, so see what happens with those numbers. Should be interesting. And a couple other those big mega cap companies report. Central banks, the easing cycle has commenced. Cut. That is the trend. Look at the difference here in terms of current central bank rates and the CPI officially reported by these governments. That is the difference. You get the real rate. Japan has been doing this negative real rates for a while. Other countries are going to have to continue to cut as inflation comes down with the growth expectations. And that's why gold keeps making all-time highs, and Bitcoin also now joining the gold train, pointing to liquidity is a coming. That's what I got for you today. I'll see you tomorrow. Have a great day.